The best financial advice I can give anyone, sell the house when you want to sell.
As people get closer to retirement, what are some of the things that they should be considering?
Well, first things first, there is no common sense left in traditional lending.
Now, what other tools other than the line of credit do you recommend?
It's so contingent on what the person's situation is.
Qualify for whatever you need going forward.
It's all about the box that the bank wants you to fit into.
Private lending is expensive money.
Expensive money.
Hi, folks, and welcome to the Mortgage Den. It's Nick Da Silva here at Northwood Mortgage, and today with me, Mr. Jason Kay. Jason, welcome to the Mortgage Den.
Thanks, Nick. Look forward to our conversation.
So, Jason, you and I were just chatting about, as people get closer to retirement, right? Getting themselves ready for the mortgage that they are going to, unfortunately, have to have on their books. What are some of the things that they should be considering as they approach that glorious age?
Well, first things first, there is no common sense left in traditional lending. So if you're nearing retirement, and even if you have lots of equity and you've been with that bank for 30 years and you've got perfect credit, if you don't fit that box, and I'm talking income here, they will not give you financing. So it's really important to plan and understand what are my potential needs, short-term and long-term. So when I say short-term, over the next 3, 4, 5 years, and long-term in the next 10, 15 years, once I retire. That could be, let's make sure we get all your debt dealt with now. That could be, is there any grandchildren or children that you may want to help with the down payment for their first homes? How are you going to do that? And finally, how are you going to live? What are your plans? Is travel on the horizon? Lots of different things you need to think about. So when I look at clients that are nearing retirement, we have that conversation, say, let's put things in place now while you still have that income that's confirmable, and deal with the what ifs. One of my favorite products is obviously a secured line of credit. Why? Is because you don't pay if you don't use. So having access to a larger secured line of credit limit once you retire opens up those options in the future. The other piece that the line of credit does is it stays on title and helps protect you with title fraud. And people don't really understand what title fraud is. They hear a lot about it, but they don't understand, and they don't think it's going to happen to them. And it's pretty prevalent today. A lot of people are running into issues where people are going in and maybe not necessarily stealing the house, but there are people that are getting financing on your house without you being aware of it. And having a secured line of credit on your house helps prevent that. I'm not saying it will prevent it, but it helps prevent it. So yeah, there's lots of great options.
Now, title insurance can also help them with something along those lines, as long as they're aware and they know about it.
Absolutely. But when do you get title insurance?
Well, normally when you buy your house, right?
And when you get a mortgage. So that's why we're preparing. Let's make sure that this mortgage that we're arranging or refinancing and adding a line of credit is going to be the right mortgage for the next 10, 15, 20 years.
Now, what other tools other than the line of credit do you recommend, whether good, bad, or indifferent?
It's so contingent on what the person's situation is. And when I say what their situation, basically 3 key things. What is their current cash flow situation? What's their current debt load? Let's get that dealt with early so that prevents cash flow problems in the future. The second piece is what is going to be their income situation once they retire. If you're stuck with just CPP and OAS, you're going to have a hard time with today's price of groceries. So maybe we need to take a look at a product that pays you a monthly income, i.e. a reverse mortgage. And let's come back and talk a little bit more about reverse mortgages. The third thing you need to look at is what's your lifestyle going to be once you retire? And there could be different phases of that lifestyle. So, phase 1 might be, hey, we want to spend 6 months of the year in travel. Or phase 1 may be, hey, we want to help our children get more financially stable by helping them buy their house, or our grandchildren. Maybe we want to help them go to university. We want to help pay for that. Longer term, is when the time comes that maybe one of us needs to get some extra care and go into a home while the other wants to stay in the house. How's that going to work from a cash flow perspective? So those are all the types of conversations we like to have as people are retiring and getting into those golden years. I mentioned reverse mortgages earlier, I should say. Reverse mortgages are probably the one product that are the most least understood in Canada. And there's multiple facets of that. The first is it's a completely different product compared to the United States. Completely different. So all of the scare tactics that you might hear, a lot of that comes from the US and how their system works. So in Canada, all providers that offer reverse mortgages have a guarantee that they cannot force you out of the house. So regardless of what happens, nobody's coming in and taking your house. The second piece is guaranteed renewal. The third piece is that there's a guaranteed equity piece. And I'm talking the traditional reverse mortgages with Home Equity Bank and
Equitable Bank.
The traditional banks, Home Equity Bank and Equitable Bank, that down the road when the house finally sells, if your reverse mortgage is $600,000 and the house only sells for $500,000, guess what? That's the bank's problem, not yours. That's the guarantee of the equity piece. So a lot of those facets are different compared to the United States. So I talk to clients about that. We also talk about the psychological piece of having a mortgage when you retire. And I ask the question, your kids, would they rather you enjoy life or would they rather have your house? And I want to say 9 out of 10 people these days say, no, my kids are great. They just want us to enjoy life. That's right. So they want you to enjoy life. Go and travel. And at the same time, if you want to help them, maybe help the grandkids with the university. Maybe gift some money to the kids before the house sells now so they can pay down their debt and start aggressively saving, getting ready for their retirement. So every situation is different, and we talk a lot about that. There are some pitfalls to reverse mortgages. Number one, obviously it's more expensive. That's the elephant in the room. Reverse mortgages are more expensive than traditional mortgages. But the benefit is that there's no payments made on it. So from a cash flow perspective, they're wonderful. So it's a conversation I have with every client, whether they're 20 or 60. We talk about rate and cash flow. So
what you've given us as a great point is prepare before you get retired. You have the income coming in, qualify for whatever you need going forward. Let's take it one step further. I didn't do that, right? I've now gone into retirement. I didn't properly plan. What are the problems I'm going to run into?
It's all about the box that the bank wants you to fit into. And one of my comments earlier was there is no longer common sense in traditional lending. So if you don't have the income to qualify properly for that mortgage, and I don't want to get into all the nuances of stress test and all that stuff, let's just keep it simple. You don't have the bank says, I'm sorry, you can't afford that mortgage. They're up against the wall. They have their own regulations they have to deal with. So now you're being forced into types of lending that don't have those same boxes, i.e. alternative lending and private lending. I don't do much private lending because I really try to help my clients beforehand prepare themselves that we aren't forced into that corner. Because private lending is meant to be short-term solutions with a clear exit strategy.
And with these folks, there is no exit strategy.
That's right.
Private lending is expensive money.
Expensive money.
And every time you need it, you go back to the well, you keep eating into your equity at a much faster pace than probably was previously anticipated.
That's right. And a lot of people don't talk about renewal fees on private lending. You're at the mercy of that individual or corporation that has that private mortgage. First of all, they may say, no, we don't want to renew. Second piece, if they do renew, they're going to give a renewal fee that's going to be pretty prohibitive. So once again, private lending is supposed to be short-term for a specific reason, and there's a clear exit plan. Retiring and not having the money for what you need when you retire is not a short-term solution. So if you're stuck into private lending when you retire, that means we know we need to sell the house. We need to access equity, but we're going to use private lending as a short-term gap for a specific reason. Maybe we need to renovate to get the house ready. Maybe it's the dead of winter and we don't want to move in winter, so we want to move in the summer, so we need a 6-month gap. But those are short-term solutions with clear exit plans.
So you're not staying in your home. You're not keeping the home during retirement. You are preparing yourself for what's to come next. The other part of it too is, if I don't want to do that, and like I said, I haven't planned properly, I don't have the income, helping my kids now become a problem, paying off my debts become a problem unless I'm going to alternative lending and paying all this extra money. I'm probably also limiting my time in that house after retirement.
You are. And the best financial advice I can give anyone is sell the house when you want to sell, not when somebody else is forcing you to sell. Meaning you want to stay in control. And when you do sell your house, obviously you want to maximize the equity that you're getting from the sale. Make those decisions earlier rather than later. There is no shame in renting. There are wonderful rental communities geared towards those in their golden years that are retired, anywhere from 50 right up to 85. There's great communities that offer some great rental products. So you sell when you're ready, so you maximize the equity, and then you go into the rental market and do that. The other piece that a lot of people are talking about right now, and I have families coming in to talk to me, so parents and their children, saying our goal is we're going to move in with the kids once we retire, or once we need that extra help. And the vast majority of children, when I say children, you're looking at people like myself, in their 40s and 50s, they want to be there for their parents. So how do we prepare for that? And that could be having the conversation, making sure that there's a home available that could be best for these two families joining together. We've
seen recently this strange phenomenon where, again, parents now going back to live with their kids.
Yeah.
It's kids live with their parents for a longer period of time. And unfortunately, parents have, and it's not a matter of the parents and the kids coming together and making a plan. It's that when not properly planned for, the parents are running out of equity in their homes. They've mortgaged it to the hilt. They've used sources which, again, are expensive. They've run out of equity. And now we're seeing this phenomenon where the parents are being forced to go back and live with their kids because they have no equity left in their homes, especially in this recent market where they've borrowed to the hilt and, didn't sell. As you said, you want to sell under your own terms. Now, when someone else is telling you want to sell in an upbeat market, and we are in a downswing market right now, and the kids are now left dealing with a parent, having a parent either in a bedroom or in a basement, right? And they just weren't prepared for it.
It's a sad situation, and I wish I had a magic wand that could go back 5-10 years and have a conversation with that family and tell the parents, let's prepare for this. Maybe let's take a little bit of equity out of your house now, and let's build an in-law suite in the children's home. Let's finish the basement. Let's put the extension on so it's ready for you to move in and become a combined family. Then, now you're in control, parents. You sell when it's best for the market as well as your own personal situation. And you have a home to go to because it's already been built. Unfortunately, I don't have that magic wand. I want to talk about renewals today.
Okay.
And the media talks about this tsunami of mortgage renewals that come into play. And they also talk about the significant rate increase that people are going to have to deal with. So I like to talk about that because the media is talking about it.
Yes.
So first things, tsunami or not, there are renewals every single year.
Yes.
If your mortgage is coming up for renewal, you need to have a conversation with somebody that you trust, i.e., a mortgage professional. And that person needs to be independent, that has your best interest at heart. The banker may not necessarily have that, or they may not have the knowledge and the different products and programs available for you. So when your mortgage is coming up for renewal, we have that conversation of rate, cash flow, and what is your medium to long-term plans. And we have that conversation because you have options available. Most of my clients that I'm having conversations, the conversation starts with, I had such a great rate. You know, they're coming out of 1.95, 2.05 fixed rate mortgages. And I say, I have good news and bad news. The bad news is your rate's higher. The good news is, thank God they're not as high as they were 18, 24 months. So today, yes, rates are higher. You're probably looking in the high 3s to low to mid 4s, depending on the product that you choose. And we say, what does that mean from a new monthly payment? And let's talk about cash flow. And we start having other conversations, i.e., you know, life is a lot more expensive right now.
Yes.
I know in my household with, two teens, like my 17-year-old son, I think he eats about $2,000 worth of grocery a week. My grocery bill has tripled in the past 3 years. So we talk about cash flow, and this renewal is going to significantly impact that cash flow. So what are some strategies that we can use to help alleviate that? Strategy number one, maybe we want to take some of that outside debt, car loans, lines of credits and whatnot, and combine that into the mortgage so your true monthly cash flow stays the same, oftentimes can be reduced a little bit. Strategy number two, maybe we want to increase the amortization of your mortgage. And people say, oh no, I don't want to have a mortgage forever. I agree, but if we increase the amortization now, that gives you the flexibility of having a lower payment. There's nothing to stop you from making extra payments and increasing your payment to what's comfortable, which automatically reduces the amortization, but at least that gives you some breathing room right now. So we look at cash flow, and that's a key thing at renewal.
You know, I was recently speaking to a senior executive at one of the major banks.
Yep.
And they've indicated to me that the average mortgage in Canada, so you got to think of outside of Canada, so in Ontario, probably a little bit more expensive, is actually going to go up by $700 a month starting in 2026.
Yep.
So again, to your, talking about cash flow and budgeting, $700. I mean, how many of us have $700 in excess money at the end of the month, right? What are we going to have to sacrifice to be able to afford this mortgage?
That's right. And okay, my mortgage has gone up $700. My mortgage is going up $700 a month. My grocery bill has gone up $400 a month. My car insurance has gone up $200 a month. My kids' hockey and dance have gone up $300 a month. Last time I checked, the average Canadian didn't get a $1,500 a month raise. So we can moan and complain and blame the government or blame whoever. Let's stop blaming and deal with reality and say, what are my options? What choices can I make right now to help alleviate some of that pressure?
Now, Jason, and it's been going on probably for the last 6 months or plus, the banks are being awfully aggressive with their pricing on their renewals.
Yes, they are.
But that renewal doesn't help you with your debt load. You now got to come back to your favorite mortgage agent and say, hey, I need some assistance. What's going to happen to their cost of borrowing? What's going to happen to their interest rate? What is the comparison right now between what you see on the renewals being offered by the big banks and what they would get from you?
So the first thing I like to clarify is, yes, the big banks are being aggressive, but there are other big banks that want to be just as aggressive. It can offer incentives to transfer over so there'd be no cost to you. The second piece is big banks aren't aggressive with every single client. You don't necessarily know what the best rate is going to be. Third piece is rate is only one part of that conversation. We need to talk about cash flow,
yes,
amortization. We need to talk about prepayment penalties. So if your plan is you may want to sell in 3 to 4, 5 years, we need to take that into account and make sure that you're in the best product that can minimize penalties in the future. Let's say I speak to 5 clients today, all have renewals. We talk about what their current bank is offering as a renewal. We talk about cash flow, and we talk about what is their short and medium term goals to stay in that house and possibly the need to have extra money in the near future. Kids going to university, we need to buy a new car, lots of different reasons. Of those 5 clients, 1 is probably going to stay with their bank because it's the best rate and they don't need any extra money and there's no cash flow issues and they're aggressively paying off their mortgage. And I'm honest with them. I say, that is a great rate. Let's save the hassle, renew with them. But that's only 1 out of 5. Those other 4 clients, I can provide a value add by saying these are the options. Yes, you can renew, or we can maybe look at this product at this bank. The rate might be the same, might be a bit more, but it might help with cash flow. It's definitely going to have a lower penalty if you need to get out of it. There's so many different factors. So I love having those renewal conversations with clients because I'm going to give great advice to all of them. But 4 out of 5, we're going to come up with a solution that their current bank hasn't even thought of.
I think we're living in a time where the average rate is not 2%. It's not that 1.95. It is going to be what it is as you see today. I mean, there's talk out there that rates may not come down any further than where we're seeing them. So you are lucky, if you are lucky, at something just over 3.5%, all the way up to about 4.5%. That's the reality of our world. You got to live with it. So, make your arrangements, make your financial accommodations based on what you see there. But as you've pointed out, cash flow, consolidate debt. You always have the opportunity, if your income goes up or you have a windfall of cash, to make lump sum payments, right? This will help you eventually pay off the mortgage.
I have a client right now that I'm speaking to, and they want to have a plan A and a plan B. And they're nearing retirement. He wants to retire in about 8 to 10 years, and he wants to be mortgage free. So it's really important to have flexibility of making extra payments and whatnot for that. The other piece is plan B, is they want to retire out east and he wants to buy a parcel of land in Newfoundland. He goes, how can I do that? How can I use the equity in my current home to make that happen? Well, what are the chances of you doing this? He goes, honestly, about 50-50. Well, 50-50 to me is we need to have a plan that not only allows you to have access that equity to buy that piece of land, but also has a plan of aggressively paying off your mortgage so you're mortgage free when you retire. We had probably about a 40-minute conversation over the phone, and he goes, thank you. It's so much clearer. My banker had no idea how to structure this.
This is why he comes to a mortgage broker or a mortgage agent. Well, Jason, thank you very much for that lovely conversation. See you folks next time, and thanks again.